I'm a believer in the fact that affordability is improving. And in that regard, we're going to focus specifically on a factor in terms of affordability that I think is at play right now, and that's days on market. So before we pull up the bullet points as to things I think you should be aware of when it comes to days on market with real estate listed for sale, I want to throw out a few numbers. And these are numbers that were published by here locally in the Coachella Valley, the Palm Springs and Coachella Valley area. And some of these numbers are pretty interesting. So let me give you a few. Paul Kaplan Group, that's a local brokerage here in the Coachella Valley. In their blog in August of 25, they indicated the typical Palm Springs home spent 119 days on the MLS. Again, that was late summer. And they also noted that on average, homes were on the MLS for over 2 months, which they argued created some space for negotiation and price reductions. Hamilton Real Estate Group, again, another brokerage here in the Valley. Their data, their blog indicated, their market update indicated that the average days on market was 88 days, which was 26% higher than in 2025. Again, this was August of 25 numbers. They argued that this is an example of a more balanced market, allowing buyers more time to evaluate their options, because that's important. Part of the problem, like during the pandemic fever, buyers just got disgruntled and disappointed with, they didn't have time to really consider their options because every listing was getting bombarded with offers. We're getting into this more, balanced market with this extended days on market phenomenon. This is good for buyers. It gives you more time to consider your options and work out some details like how to make the offer. Do you want to get concessions? Do you want to try to get seller credits for buy downs and so forth, closing costs? So that's why these kind of numbers are actually good for the real estate market overall. Here's another one, Greater Palm Springs Business Insider. Their December housing report that across the valley, median days on market was 53 days, 10 days longer than the previous year. And detached homes and attached homes were selling about 2.5% to 3.5% below list price, and only less than 12% of properties were selling over list price. So again, more indications that we've got more housing inventory and more room to negotiate. Again, another update from Paul Kaplan Group, December. The year-end update listed a median home price or a median days on market of 47, so a little bit better than earlier in August. It's and still 6 days higher than December. And again, only about 11% of homes sold over list, and they also quoted the same 2.5%, 3.5% sale price to list price, below on most transactions. Hamilton Real Estate again in December. Their numbers indicate 71 days on the market, down from 81 days in November, but nearly the same as December of 24. Most communities saw homes selling 60 to 75 days. Desert Hot Springs, north of us here in Palm Springs, 81 to 86 days. And again, one other thing very important as it comes to home values. Now, overall home values, I would argue, are still gradually improving, but at a much decelerated rate. Palm Springs Property Management November of 25 blog indicated the average home price here in the Coachella Valley dropped about 5% to $624,000, and that home stayed on the market for about 71 days on average. So when you put all this together, what does the data illustrate? A clear trend, actually. Although the average days on market shortened at the end of 25, they remain far higher than during the pandemic surge, and some neighborhoods still see houses lingering for months. As a result, sellers are increasingly flexible and open to negotiations. I'm seeing that in our loan originations. On resale transactions, when we get contacted to pre-qualify a buyer, we are seeing more and more cases where the buyer's agent and the buyer are looking to negotiate concessions, and I'm seeing in most cases they are being successful. So with those data points about days on market, let me kind of give you some of the reasons why this is so vitally important if you're a home buyer, and why you should consider this environment, again, a very good time to finally get into the arena and try to buy a home, because their opportunities are out there. So what does the longer days on market mean to buyers and sellers? Well, the first one is increased negotiating power for buyers. As I said, we're seeing that now. We're helping buyers when we pre-qualify them to do this, negotiate some concessions when you're making when you make the offer. As it says there, when homes sit on the market for weeks or months, sellers are motivated to attract buyers. Now, there are some stories that sellers are hung up on what they think their home is worth and they're pulling their house off the market instead. I would argue, even to the extent that has been happening, I think that's getting more diminished in terms of the actuality of it. And I'm seeing more indications that people are taking advantage of the opportunity to negotiate. What's the other thing? As I mentioned earlier, more time to shop and compare. Again, back during the pandemic surge, buyers were just frustrated to no end because everything was at a very rapid hurry up pace. I mean, people were making offers on homes without even seeing them. They would just rely on their agent to go view the home and maybe send them some pictures, but they weren't actually, kicking the tires, if you will, themselves. Well, with this situation with days on market and the fact that homes are now on the market on average for more than a couple of months, for a buyer, that gives you more time to shop, compare, and to look at other strategies such as buy downs, paying closing costs, things of that nature. The other thing to consider is these kinds of numbers, this extended days on market. It puts more pressure on the sellers. It puts more pressure on them to price the home correctly, because what they have to watch out for, if they're too ambitious on their price and their home ends up sitting on the market for more than a couple of months, that becomes what we call a stale listing. If it's been on there for more than a couple of months, and if there's an impression that seller is kind of drawn a line in the sand and they're not likely to want to consider an offer that's below their asking price or consider offering some concessions, that's not a good outcome for the seller. You're going to find yourself in a lonely place where you're just not seeing any offers. You're going to see less people even looking at your home once they see you've been on there for 2 to 3 months. And if the word is out, you're dug in and you're not willing to negotiate, most realtors are going to take their buyers and bypass your listing and go on to the next one. So this kind of data, this kind of environment, extended days on market, theoretically, and I argue should put more pressure on the seller to price the home correctly. And if their initial price is not correct, if the market is screaming at them that you're overpriced, then at a minimum, you can still address that. When you get that offer, negotiate some concessions that you'll offer, maybe in return for getting that offer at your list price, but give up some dollars, give that to the buyer. That way, what you're doing is you're helping them address their biggest concern, affordability, right? So if you're pricing your home at a premium and the market is starting to tell you that it's priced too high, get the word out that you're willing to negotiate some concessions. And then that way, those concessions, not in terms of a lower price, but in terms of a seller credit, can then flow to that buyer and directly head on address their concern about mortgage rates, about payments. And so that's why this extended days on market should be, and I think is starting to put more pressure on sellers. And we're starting to see that in some of these contract negotiations. And finally, with this kind of extended days on market, as I alluded to earlier, and as one of the blogs I just quoted from indicates, it's a more balanced market. You've got a situation now where we don't have bidding wars, we don't have listings with 16, 20 offers. We're seeing a leverage toward the buyer. And with that situation, more leverage to the buyer, they can negotiate not just the price. Now, a lot of them still do. They just negotiate off the price. They keep it simple. That's fine. If I have an opportunity, though, if I'm pre-qualifying a buyer like that, and they're thinking in terms of, I'm just going to negotiate a lower price, duly noted, I'm certainly willing and able and do pre-qualify them based on that scenario. But I always try to leave them with the idea of, look at another way of handling that. Look at another way of getting that concession in terms of dollars from the seller rather than dollars off the price. And then what I do is show them how that can make a huge world of difference to them in terms of their their strongest concerns, their biggest concerns, rates and payment. So again, when you take all of this as a whole, this extended days on market in this market here in the Coachella Valley, Palm Springs, Coachella Valley area. And I would argue this is happening in many parts of Southern California, as well as maybe the state throughout. With this happening, this is why we say there's been a shift in the market. There's more pressure on sellers. There's more leverage for the buyers. And you put those two together, and we're seeing the outcome of this in all the transactions that we're handling now and new ones that are coming at us. And we can become a part of your team with your agent to give you some ideas how to take advantage of this extended days on market and get some concession and then use that towards your loan in a more effective way. And given that presentation that I just gave you, what I want to do is show you a real life example. I had actually touched on this here a week or two ago on the program, but I wanted to dive a little deeper just to give you some real hard, accurate, live numbers on a transaction we have going right now that we're going to close in about 10 days. So Jeff's going to pull it up. And again, I'm going to call this home affordability in action. This was a resale transaction. I was approached by a real estate agent a couple of weeks ago about a buyer who I actually helped her. I pre-qualified the buyer last July. They're first-time home buyers, young couple. They weren't interested in buying right at that time. They wanted to hold off, and they wanted to wait until early this year. So sure enough, a couple of weeks ago, I've heard from their agent and them, and they said, we're ready to go. So let me show you, and I tried to kind of keep this kind of in a summary fashion, but give you very pertinent numbers so I could better illustrate what I'm referring to. The list price of the home, $475,000. It's a listing in Indio. What we ended up doing is we're using an FHA loan with a 3.5% down payment because these buyers had not a lot of money for down payment. And even though they're first-time home buyers, by the way, we were using FHA more because of their credit score level and because FHA rates are generally better than conventional. You don't have to be a first-time home buyer to use FHA and be able to buy a home with 3.5% down. So don't forget that. Don't think by this presentation and this particular transaction, you have to be a first-time home buyer to get these kind of terms. It happens to be, in this case, the borrowers are, but you don't have to be a first-time home buyer if this kind of approach might be of interest to you. So when I was presented with this transaction to pre-qualify the buyer and given those parameters, what I first was told by the agent is they thought there was some concession likely, and they were going to offer $450 instead of $475. And again, I told them, sure, I'll be happy to issue the pre-qual based on that, the pre-approval. But I asked them to consider another option, and that is get the concession not off the price, but in dollars from the seller. The buyer's agent, ended up getting wind that a seller might actually entertain an offer that was at least $440. So based on that, I'll call it quote unquote intelligence, market intelligence, after talking to the agent and her buyers, we decided to kind of go after it in a bigger way and ask for a credit, not just of $25,000, which would have been the same concession if they just took it off the price, but instead ask for a credit of $28,500. That number wasn't by accident. That's 6% of the list price. And on an FHA loan, even with 3.5% down payment, seller concession up to 6% of the price is allowed. So in this case, the agent, based on what she gathered from talking to the listing agent and so forth, that $440 might be a serious offer that they would consider. They decided to offer $475, but ask for $28,500 in a seller credit, not off the price. So what does that mean as to the rate? Next line item you can see there. If they went with the offer $450, $25 under sale list price, so they're on their own in terms of the financing, no dollars from the seller to cover anything, buying down the rate or for their closing costs. What kind of rate were they going to get? Well, with a 688 score, it was going to be 5.5%, 30-year fixed, no points. By the way, that's an example of how with a 688 score, FHA by far is a better option than conventional, because at a 688 score on a conventional loan, you're not going to see 5.5. You'd probably see 6.25 or 6 3/8. So FHA gives you a great and very substantial interest rate advantage when you're in that sort of middle tier in terms of credit score. So 5.5% would have been the rate if they just offered 25 off the price. In this case, because they did get their offer accepted with the 28.5 seller credit at the full list price of $475, we were able to take those dollars, and they're getting a 4.5% interest rate, 30-year fixed. That's like 1.5% below market when you keep hearing about mortgage rates are 6s, 6.25, and so forth. 4.5%. I cannot stress enough the psychological benefit to these first-time home buyers who've heard nothing but negative news about how unaffordable buying a home is and how rates are so terribly high. When I told them that they were able to get a 4.5% 30-year fixed by this strategy, they were ecstatic beyond belief. I mean, they could not have been happier, and I don't blame them. So that's part of one of the subtle things I would point out with these kind of strategies. Don't underestimate the the psychological benefit to a first-time buyer who's never been through this process before. They've heard nothing but negative stories about how mortgage rates are terribly high and or double what they were during the pandemic and this and that and the other. And like, guess what? I can get you 4.5. They're like, you got to be kidding me, right? They didn't believe it at first. It's like, no, let me show you. So here's the next line item, P&I payment. And this may look like not that much of a difference, but hear me out because it's more than what you think. If they were able to get $450 on the home with no seller credit at all, and they get a 5.5% rate, the principal and interest payment is $2,500. At 4.5, where they offer the higher full price but got the seller credit, the 4.5% interest rate, it's $2,363. Well, you go, oh well, what the heck? I mean, that's $137 a month less. That's not that big a deal. Well, understand too, you always want to look at these options relative to your baseline. And what's your baseline? Your baseline would be, what if you couldn't get the seller to budge at all, but you really wanted the house. And so you go ahead and offer $475 and they accept $475 and you don't ask for a credit. They don't give you a credit. So you're left with a market rate. You're paying all your closing costs. And of course, at the market rate, using a $475 price and the corresponding loan amount, the P&I payment, which I don't have on the slide here, would have been $2,634, or actually $2,648, almost $300 higher if they paid full list price and got a market rate, versus going this direction, getting that seller concession and getting the $2,363 P&I payment. So when you consider that is a huge benefit in terms of a lower principal and interest payment by using this strategy over just going with the market rate, or even going with the market rate and getting the concession in price by $25,000 at $450. So here's the bottom line. Oh, well, actually, before I get to that, the total cash needed. Now, by the way, these two numbers, down payment, all closing costs. Again, if you offer $450 and you get that accepted, so you've gotten a $25,000 concession off price, but you're going to take the market rate, you're on your own for closing costs. So between your down payment, 3.5%, and your closing costs, you're looking at about $31,500 total cash needed. Well, with this buy down strategy and getting the seller credit of $28,500, the seller credit covered all the points necessary for that 4.5 rate, which is about 4.5 points. But there was money left over, like over $7,000 left over. So as a consequence, you can see that $23,853, that's the total amount needed to buy the home between your down payment and your net closing costs after you use the remaining portion of the seller credit to cover those costs after the credit's used to pay the points to get the 4.5% rate, if you follow all that. So that is why, if you look at that bottom line there, if this first-time home buyer, they're going to be able to, they're purchasing this home with 3.5% down, a 6.8, and given their 688 score, they've negotiated getting an FHA loan at 4.5% with less than $24,000 out of their pocket needed to complete the purchase. And then here's the bonus. There's a system that we use in real estate. Realtors use it. I use it when I'm originating mortgages because I always want to look at properties and get the detail on the property. I need to know about the property and so forth when we're going to put a loan on it. There's a system called Realist. So I pulled a Realist report on this particular property. This report provides public record data for homes. And when I looked at that, there's a section of the report now that uses automated valuation models, software, to identify the estimated market rent based on the type of property, the size of the property, the age, and so forth. Well, guess what? For this particular property, the realist report shows that the estimated market rent for this property is $3,400 a month. By the way, we keep hearing, oh, rents are a lot less than mortgages, having a mortgage. Not necessarily. Why? $3,400 a month, estimated market rent for this property, according to the realist report. Well, if you look at that principal and interest at $2,363, again, you've got to add to that property taxes, homeowners insurance, and in this case, it is a planned unit development. It's a single-family home, but it's in a community with HOA dues. So including taxes, insurance, HOA dues, add that to the $2,363, guess what the outcome is? The total housing expense is only about $200 a month more than that $3,400 for rent. To me, that's a really eye-opening big bonus to this whole scenario, this whole transaction, because what this illustrates, again, to these first-time home buyers, for only a little bit more than you would pay for rent. And if you're able to come up with this relatively modest amount of down payment and closing costs, a little under $24,000, you can own this home rather than paying $3,400 to the current owner and renting it and have no opportunity for appreciation, have no opportunity for wealth creation. So this particular transaction, a real life transaction, we're going to close in about 10 days. It basically does a pretty good job of exploding what I would argue is at least somewhat of a myth that you cannot negotiate affordable terms to finance and buy a home versus just renting it, because in a lot of cases, the market rent for a property you have your eye on isn't going to be that substantially lower than what you can do to finance it, even with a minimal down payment. You just need somebody like us to help you with those numbers and illustrate that point to you. So you're going to feel much more comfortable pursuing this deal, because that's going to give you, again, home ownership, wealth creation, the tax deductibility of mortgage interest. You can deduct your property tax expense. There are multiple benefits to owning the home versus renting it at $3,400 a month. Again, if you can own this thing for $3,600 a month and get all those associated benefits of home ownership, why would you not do that? So I would urge you then, given these numbers, affordability is back, it's possible, and we are happy to help you see that and give you numbers to underscore that. So you're going to be in a much better frame of mind to go out there and take the time. You now have the time because of the days on market phenomenon we're seeing. You don't have to rush this. You've got adequate time in most cases to go out there and negotiate some very favorable terms to address affordability and feel really, really good about getting into home ownership. Because again, as I said earlier, the psychological impact. I mean, imagine when these young folks get, their next cocktail party and they talk to people and their friends, and they say, hey, yeah, we just bought a home. Oh yeah, what kind of rate did you get? We got a 4.5% 30-year fixed. They're going to see jaws drop. They're going to go, how did you do that? When we're hearing that mortgage rates are like still elevated, too high, unaffordable. Not true, folks. We can help you see through that and get you where you need to be. So with that, I'm going to conclude today's edition of the Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. I want to thank you for watching and listening. And I want to urge you to have a great weekend. Let's see what happens with the NFL playoffs. Like I said, I'm looking at Seattle to go all the way. Regardless of who you're rooting for, enjoy those games and enjoy your weekend. And then we'll see you again next week on the next edition of the Mortgage Minute. So long. Take care.